I want to talk about our outlook for 2014, which is why you're here after all. The last 5 years or so, and this, by the way, is I think our 6th year at the Vaughan Estates. The last 5 years or so, I've been talking a lot about the U.S. economy and the macroeconomic environment because, of course, we had this very bad event in 2008 when the world banking system almost ceased to function, when the U.S. economy suffered its deepest recession since the 1930s, when housing fell out of bed and unemployment rose sharply. I'm happy to say tonight things are good enough that I'm not going to spend as much time talking about macroeconomics. I'm going to talk more about investing, our investing process, and specifically about our outlook for stocks and fixed income during 2014. But before we get there, we have to set the stage by talking a little bit about what we think the macroeconomic environment is. So if you'll open your books to section 1, which is called The Slow Motion North American Recovery Continues. If you were here last year, you will remember I stood up here and I said there is not going to be a double-dip recession, and there wasn't. What I said was that we're going to have slow growth continuing, and sure enough, that's exactly what we've had. The slow growth, about half of what we would like to see coming out of a very bad recession, is a result of a number of factors. And if you look at the graph with the blue bars at the top of the first page, what you'll see is that GDP growth in the United States has been around 2% per quarter. Not recessionary, but not gangbusters by any means. And the problem with growth at 2% is it doesn't create a lot of jobs. It doesn't induce a lot of investment in new factories or plant. In other words, it doesn't create a takeoff for faster growth in the future. It's slow motion growth, not recessionary, but not great. One of the reasons that growth in the United States has been so bad, and of course Canada follows the United States closely, has been this odd situation going on with the U.S. Congress. And if you look at the graph at the bottom of the page, you'll see there's a downward spike in outlays by the federal government. That's the result of the sequester, the failure of the Democrats and Republicans to make a deal on the U.S. budget that resulted in automatic budget cuts. Normally, when you're coming out of a recession, what you want is for governments to spend more money to stimulate the economy, to create jobs and spending, and create the conditions for a more vibrant recovery. Instead, what we have in the United States on all three levels of government, federal, state, and municipal, is cutbacks exactly at the time when stimulus is needed. This is a result of this very divisive environment between the Republicans and Democrats, and the fact that the states and cities are largely broke in the United States and simply can't spend more money. So the deficit in government spending has been fighting with stimulative monetary policy from the Federal Reserve Bank, and the result has been a stalemate, and that's why we have slow growth, and that's why the employment situation in the United States has been mediocre. If you turn the page to the one with the very bright red graphs, what you'll see is the monthly job additions in the United States. In order to fix unemployment in the United States, there has to be about 350 or 400,000 new jobs created every month. The United States job market grows by about 150,000 people a month, and the job creation has been about 150 or 200,000 a month. In other words, enough to absorb the new people and not create new unemployment, but only a little bit to claw back the huge unemployment that there is. And if you look at the graph at the bottom with the bright red line, what you will see is that U.S. unemployment during the height of the recession spiked at over 10%, and it's gone down to the mid-sevens, but you can see that it's way above where it was before the recession. Way above. And I think the best graph to illustrate this and to show why this recession was so different from every other recession in the post-war period is the graph with the colored lines on the top of the next page. And what that red line on the bottom shows is the number of months since the recession started, which is now out around 60 months, 5 years, and the percentage of jobs lost and then recovered. Every other recession, all the jobs lost in the recession had been recovered within 4 years, mostly within 2.5 years. Here we are 5 years after the start of the recession, and you can see that 2% of the labor force jobs lost in the recession have still not found jobs. And that's the other reason growth is so slow. There's this huge overhang of unemployed people. A lot of that unemployment has been in the better paid manufacturing jobs. And if you look at the graph at the bottom of that page, what you will see is the very sharp drop-off in manufacturing jobs, like falling off a cliff, and the very weak recovery in manufacturing jobs. During the recession, about 2 million manufacturing jobs were lost, and they haven't come back. A lot of those were auto workers, steel workers, the higher paid, unionized kind of jobs where people were middle class. They were making $70,000 or $80,000 with good benefits. A lot of those jobs, to the extent that they've been replaced at all, have been replaced by jobs in service. And as I think most of us know, the service industry jobs pay less than manufacturing jobs, and in particular, non-unionized service jobs pay a lot less than unionized manufacturing jobs. So the auto worker who's now working as a greeter at Walmart, or his kid who might have been an apprentice in a trade is now a barista at Starbucks, has basically replaced $60,000 or $70,000 a year jobs with $18,000 or $20,000 a year jobs. The effect on US GDP is striking. On the next page, I want to bring this point home one more way by looking at the participation rate. The participation rate for any economy shows you what percentage of all adults are in the labor market, either employed or looking for jobs. The line at the top, the darker line, shows the participation rate, which peaked in the United States at 67% of all adults, but has now fallen to 63%. 4% of all adults have either have dropped out of the labor force, essentially. That's about 12 million people are no longer actively in the labor force, either because they've gotten old, or they couldn't find jobs and became discouraged, or they simply don't feel that they can do it anymore. And the actual employment population ratio was 64%, that's the line lower down, is now 58%. 6% of the population, these are people who would still like to work, but can't find jobs. That's the hardcore unemployment rate. And many of those jobs aren't coming back. One of the reasons has to do with the nature of new jobs. I was in Hamilton on Tuesday visiting clients, my hometown. Hamilton has changed radically in the 40 years since I left there. When I left Hamilton, Hamilton was run by the steel industry, by Stelco, DeFasco, National Steel Car, and the industries that grew up around East Hamilton to service those industries, the scrap yards and the recyclers and so forth. Hamilton is now a white-collar town. It's run by McMaster and the hospitals and the university. And the problem is a 50-year-old steelworker does not get retrained to become a medical technologist or a university lecturer. Those jobs are not fungible. They're not interchangeable. And unfortunately, what happens in that situation is you get hardcore unemployment that's very hard to fix at the same time as you have job openings which are hard to fill. And in Hamilton, it very neatly falls into West Hamilton, which is where McMaster is, and East Hamilton on the bay where the steel companies are. This is a story that's all over North America and quite intractable. However, the situation in the United States is not all bad news. Those of you who've heard me the last 6 years heard me talk a lot about housing. We had pages and pages of housing graph. This year, only one. On the top of the next page, because it's good news, housing starts in the United States, which had fallen to as low as 380,000 a year from over 2 million. Think about that, 2 million to 380,000. That's a drop of more than 80%. Rebounded very sharply in the last 2 years, basically up 50% to over 650,000 for single-family homes, and up to almost 1 million for multi-family homes. That's very good news. The devastating part of the housing crisis was not just construction workers, but everything that went into a house wasn't being purchased. Appliances, carpets, wall coverings, paint, furniture. If no houses are being built, that stuff isn't being sold. So the fact that housing starts are up sharply is very good news for the U.S. economy. And the second thing that's very good news for the U.S. economy is that banks have started lending again. If you look at the graph at the bottom of that page, you'll see that bank lending fell very sharply after the recession. Banks were in deep despair. They had to fix their balance sheets. They became gun-shy. They stopped lending money, and you can see that graph. But then if you look at what's happened in the last 2 years, bank loans are at a record high. Banks have started lending again. The creation of credit, particularly commercial credit, is crucial for growth in the United States. So good news there. And our situation in the United States is we basically think moderate growth again in 2014. We think that Congress has more or less got its act together. We don't see any great changes, either up or down. Another year of 2.5% growth. Not so bad. Canada, on the next page, has also been struggling. In spite of every prime minister in my lifetime trying to diversify Canada's exports, 70% of Canadian exports still go to the United States. We've apparently now signed a free trade agreement of some kind with the European Union, which can only be good news, I guess, unless you're a cheese manufacturer. And I got to say, by the way, do we have any dairy farmers here who are going to throw milk at me? It takes a lot of gall for the dairy farmers to complain. They've been living behind a tariff wall, and we've all been paying too much for milk and butter and cheese for years in Canada. It amazes me that they have the nerve to complain. That's an aside. We're trying always to broaden our export markets, and if Europe opens up to us more, that's good news. But Canada GDP growth, as you can see in the last year or two, has been very, very mediocre. As bad as the United States, or even worse, less than 2% a year. That's pretty slow growth. And if you look at the graph at the bottom of the page, you can see that here we are, 5 years after the recession started, per capita income in Canada is still less than it was before the recession. In other words, households are still behind where they were 5 years ago, although they've caught up a lot in the last 3 years. Unemployment in Canada, better than the United States. We didn't peak as high as the United States. We only peaked at 8.7% compared to 10% in the United States, and we're now down to about 7.3%. But part of that is because of people dropping out of the labor force. Not all good news. I want to talk tonight, for the first time in the last 6 years, about demographics and the effect that it's having on economic growth. And there's a very strange-looking graph on the bottom of page 9 there, which my wife tells me is impenetrable, but I'm going to try and explain it to you because it's important. What you see here is what's called an age pyramid, and the concept is from age 0 to age 100, women on the right, men on the left, the bars show you how many people per thousand are in that age group. So if you look at the filled-in blue area, and if you look at 0, you can see that at the moment, about 6 out of 1,000 people in Canada are males who are just born, about the same number of women, same number of girls. And if you look up at the age 80, say, you can see that about 3.5 men in Canada out of 1,000 are 80, a little bit more women because they live longer than us. But the contrast to be drawn here is between the filled-in blue area and the solid dark blue line. And the difference is this. The solid dark blue line is the situation as it was 40 years ago in 1971, and the filled-in area is the situation today. And what you can see, there's a lot more old people. In other words, the filled-in area goes outside of the solid blue line after age 30. That's the baby boom. That big clump of people, sort of the fat hips sticking out, that's people born in my generation who are now in their 50s and 60s. You can see them sticking out today, but that wasn't the case 40 years ago. 40 years ago, we were down in the 10 years 10-year-old range. But what's happening is, as my generation moves up that pyramid, the older sections get filled in and the younger sections get hollowed out. So if you turn the page, I want to show you the implications here because it's striking. The graph at the top of page 10 shows you the growth in each age cohort. If you look at the right, 100-year-old people are growing at 10% a year, which is amazing if you think about it. And 90 and 95-year-olds are growing at around 8 or 9% a year. This is because people are living longer, as we all know. But if you look at the other end of the graph, the shocking thing is people over 50 are growing much faster than every age cohort under 50. Think about that for a second. More people over 50 and those cohorts are increasing. The cohorts under 50 are not increasing as fast. And the result is the graph at the bottom of the page. In 1971, at the left-hand side of the graph, 30% of Canadians were under 14 and 7.5% were over 65. There were 4 kids for every senior citizen. 4 kids for every senior citizen. In 2016, those lines cross over, and you can see it here, and that means there's going to be 1 child under 14 for every senior citizen. In 40 years, we'll go from 4 children per senior citizen to 1 child per senior citizen. And if you have the nerve, you can look further down the graph, and you'll see that eventually there's 1.5 senior citizens for every child. The implications of this are profound. Old people, and I'm becoming one of them, require more health care. They don't need schools. They don't need school teachers. They need caregivers. They need nurses and doctors. They need hospitals instead of schools. They need hospices instead of high schools. It profoundly changes the way that we have set up the economy because of the change in demographics. And we talked about this last year, the old people keep wanting to work because they're healthy and they feel good and they don't want to be bored, and they're clogging up the labor system. I'm sure all of us know kids in their 20s who have graduated from teachers' school and are having trouble finding jobs, and one of the reasons is teachers get to be 65 and they say, you know what, I think I'll do supply teaching for the next 5 or 10 years because I still feel good and I could use the money. And they clog up the system. And this is not going to go away. People are going to be active well into their 80s, some into their 90s. And this is something we're going to have to accommodate ourselves to. It's a real change in the economy. It's going to change the nature of everything we do. It changes the nature of pension plans, insurance. Insurance companies, wrote insurance 40 years ago, confidently expecting that 1/3 of the people in the room here would be dead. And you haven't accommodated the insurance companies, and they're very disappointed. It makes a big change. The big war, the big political war that we're going to see in Canada is going to be about pension plans. And if you read your newspaper today, you saw that Catherine Wynne, the Premier, talked about setting up a pension plan for Ontario. The reason is, as seniors live longer, if they haven't saved enough, they can go into penury. In other words, they can live longer than their money lasts. And governments who can read these charts as well as I are concerned about this and are concerned that people aren't saving enough. This is going to be the big fight of the next 20 years. That's the macroeconomy. Not so good, not so bad. It's the way it is. I want to talk about Europe very briefly. Last year when we were here, we were very concerned about Greece defaulting on its debt, Spain defaulting on its debt, Italy defaulting on its debt, Portugal, Ireland. We were talking about pigs. Do you remember that? Portugal, Italy, Ireland, Greece, and Spain. Nobody defaulted on their debt. Europe has turned the corner. It hasn't made a sharp turn. It's not a U-turn. It's a gradual, slow turn. But it's turning in the right direction. And if you look at the graph at the top of page 11, you can see that Europe has gone from a recession to growth, albeit small growth. That unemployment has plateaued and is starting to go down. If you look at the next page, United Kingdom employment is falling quickly. German employment is rising. Unemployment is falling quickly, which is important because Germany is the biggest and most important economy in Europe. What we see is better conditions. And as a result, these countries which were in the sort of intensive care unit have come out of the intensive care unit. If you look at the very pretty graphs on page 13, appropriately for Italy we have green and red, you can see that Italian bond yields spiked at over 7% exactly 2 years ago and are now down to under 4%. This is important because it allows countries like Italy to handle their debt at a reasonable interest rate. If they had to pay 7% on their borrowing, they would be defaulting. At 4%, they can handle it. Same thing for Spain. Spanish bond yields peaked 1 year ago, over 7%. They're also now down around 4%. And by the way, we had a really funny thing happen. I don't know if it was funny. 5 countries in the world were paying less interest on 5-year bonds than the Americans 3 days ago because people were concerned about default. It's a long time since that happened. So Europe, we think, is okay. You'll notice, if you're paying attention, I'm not talking about Asia this year. I want to talk more about capital markets, but Asia's okay. Some interesting things happening in Japan, some interesting things happening in China. India's a bit of a mess. I don't have time to go into it tonight, but Asia's similar, okay. So the macroeconomic environment in general, not striking, not great, nothing hot, nothing to be really pleased about, but nothing to be panicked about or overly concerned. It's simply chugging along at a very moderate rate. And we may see that for quite some time because of these demographic problems and persistent hardcore employment problems. So what does that mean for us as investors? So that's what I really want to talk about tonight, is what should we be doing given these facts? So if we turn to page 14, first of all, I want to talk about the TSX, our stock exchange, which, by the way, got to above 13,000 today, first time in 2 years. It's great, but it doesn't matter. Why doesn't it matter? It doesn't matter for you and for us because we don't really buy the TSX. What we really buy are stocks, which are part of the TSX but not representative of the TSX. So if you look at the graph on page 14, you'll see that we've underperformed the American markets in a very striking way since 2009. Investing in the S&P has been much better, particularly since the Canadian dollar's gone down a little. And why is that? Well, mostly because of what makes up the TSX. And if you look at the pie graph, our only pie graph tonight, on the top of page 15, it shows you the makeup of the TSX in 2011. And you can see that the two big sections are commodities. They're energy and materials, the green and the red. 50% of the TSX is concerned with mining and mineral extraction and oil and gas production. If you owned all those stocks, if half of your portfolio was made up of commodity-related stocks, you did lousy in 2011, you did lousy in 2012, and you've done lousy the first 9 months of this year. But happily, this is not the case for anybody in this room, because at the moment we have zero mineral and metal exposure, zero. We have one agricultural company, Potash Corp, and I think we have 3% exposure to oil. So this 50% of the market, the TSX, in our portfolios, about 4% of our portfolios. That's why we've done so much better than the TSX, and that's why the performance of the TSX is not really relevant to what's happening at Baskin Financial. Look at the line graph on the bottom of page 15, and you can see the sectors that have done well and the sectors that have done badly. And as you expect, materials and energy have done lousy. Utilities has been mediocre. And the best sections are the smallest parts of the pie graph. The smallest components of the TSX are the ones that have done the best. So because we're looking to be in those industries, you'll also have noticed in your portfolios that American stocks have become more and more prominent in your portfolio. We sold all of our American stocks in 2009 when the Canadian dollar was 75 cents. We converted those American dollars back to Canadian dollars at $1.30. We waited 2 years, and now we're putting them back in the market, and we're buying American stocks, which now, for most of you, you'll find American stocks are a quarter to 30% of your equity exposure and growing, because we feel there's more opportunities there. So TSX at 13,000 is nice, but not very relevant to us. So I want to talk about how we think as value investors and how it is that we don't follow the index and why our investors don't look like TSX holders. When we invest, we start by what we just did for a few minutes, talking about macroeconomics. We're looking at the economy as a whole and trying to find sectors that are going to benefit from whatever the economic conditions happen to be, or sectors that are going to do very badly from how the economic conditions are going to be. And if it happens that we think that shale gas is going to affect the energy industry and make investing in oil and gas and nuclear power and coal really a bad idea, we'll go to zero in those industries. And if we think that you have to be slightly demented to own a lot of gold and silver, we won't own any, and we don't. And by the way, I said that last year and I lost a client who I offended because he liked gold. Well, there you go. Can't make everybody happy all the time. We own no gold and silver, and we have no plans to own any gold and silver for the next little while because we think there's no reason in the world gold couldn't go to $1,000 an ounce, and there's no reason in the world silver couldn't go even lower because the industrial uses of silver, primarily in imaging and photography, have disappeared because of digital. So if we don't like it, we don't buy it on a macro level. But when we look for companies, what are we looking for? Well, we look for companies with strong balance sheets. One way we know that is that companies who have excess cash on their balance sheet buy back their shares. And the graph on the top of page 16 shows that companies that buy back their shares do better than average companies. And we've been buying a lot of those. We like companies that grow their dividends. Growing their dividends means the board of directors of the company has a lot of confidence that the company is not only going to make money, but is going to make more money. And if you look at the graph on the bottom of that page, you can see that dividend growers do the best of any sector in the market. We like that. We like companies with a high return on equity. That is to say, they're using their shareholders' money to advantage and making money on it. Those companies do well. So, how do we apply these principles? We've given you two case studies where we can talk about how we've applied that. The first is Home Capital Group, a company that has done great for our investors and hit, I think, a new all-time high this week, if I'm not mistaken. Home Capital is in the business of mortgage lending, but it lends to people who don't have normal jobs and get T4s. It loans to long-distance truck drivers who are independent contractors. It loans to small businesses where people are self-employed. It loans to farmers who don't have a T4, they have a farm. People say, gee, that's risky. It's not as straightforward as loaning to a guy who works for a store or works at a plant somewhere. They happen to be very good at it. So how do we look at this kind of company? First of all, from a macro standpoint, we always start with macro. Low interest rates we know are going to be around for a long time. Very favorable for mortgage lenders. People don't default when their mortgages are at 2.5%. When mortgages are at 12%, they do default. Federal government policies to cool off the housing industry has made mortgages safer. That's great for Home Capital. The sector, Home Capital has found an underserviced sector, a niche in the market. They're not competing with Royal Bank and TD Bank, who don't want to go in these mortgages that are harder to analyze. They're competing with a couple small companies like Equitable Trust, just a few. And non-traditional unemployment and self-employment is the fastest growing part of the Canadian economy, so there's more demand in that sector. So we like the macro, we like the sector, and then we look at the company. We are numbers-driven investors. We are, in the investment world, fundamentalists. That means we take apart financial statements, we read balance sheets and income statements, and when we look at Home Capital, what do we see? Very strong balance sheet, return on equity of 23.6%. That's very good. Compounded growth in earnings of almost 19% over the last 6 years. Yet, we can buy this company at 70% of what you pay to buy a bank, a price-to-earnings ratio of around 8. We look at that combination and say, why wouldn't we want to own that company? And if you turn the page, you can see that eventually people agreed with us. Home Capital is up 75% from a low it hit in May, when some of you may have read an article in the Globe and Mail about a hedge fund in San Francisco that put 80% of his money into shorting Home Capital Group. not heard of since. It was called the Great White Short. Do you remember that? They were shorting banks, Canadian banks, because they thought they were all going to implode. Didn't happen. Another one, Energizer, an American company. You all know Energizer for batteries, but Energizer makes other stuff, a lot of consumer staples. It's transitioning from batteries to personal care products like razor blades and sun care products. It's a slow growth segment, but a very steady segment. People have to shave every day. Batteries wear out. Sunscreen, you got to put it on. This is a company that's a lot cheaper than the other big multinationals like Procter & Gamble and Johnson & Johnson. The company buys back its stock. It's got a strong balance sheet. It's increasing its dividend. It's got a lot of free cash flow and a 20% return on equity. So again, this is a case where we look at the macro, we look at the sector, we look at the company internals, and it convinces us to buy the stock. And boy, look at that, it went up. Not every company we buy goes up. You can make a mistake in any of those three areas, and you can get sandbagged by things you didn't expect. Every company is particular. It has its own management. It has its own peculiarities. You can't get everything right. But this is our process. This is how we find companies to add to your portfolios, hardcore value investing. So now, not doing so bad. I want to talk about our specific outlooks for fixed income. In May and June, there was a panic in the market. The federal government in the United States was talking about tapering. That is to say, less intervention by the Federal Reserve Bank in the market, less buying of bonds. And people said, well, that means interest rates are going to go up. We better sell our long bonds. And long bond yields shot up. Because when people sell bonds, bond prices go down, yields go up. And we saw the yield on the 10-year U.S. bond almost double in a period of 90 days. This had a profound effect, of course, on bondholders, preferred shareholders, and also holders of interest-sensitive stocks like utilities, pipelines, real estate investment trusts. What has happened since then is the Fed said, you misunderstood us. We don't want interest rates to go up, at least not suddenly. We feel the economy is now sufficiently strong that we don't have to intervene, but it doesn't mean interest rates are going to go up. And now, what we understand from looking at the numbers is that we're not going to see any tapering of this bond buying program probably until the spring at the earliest, and we're going to see interest rates stay low for probably 2 to 3 years. So that means that yields on bonds are going to be mediocre, but it also means the danger of holding bonds has been overestimated. People got too pessimistic. So we see, and you can see the graphs here, you can see that sharp spike in the spring of interest rates just doubling in a very brief period of time. We see these interest rates receding, and in fact, the 10-year bond in the United States today is back to 2.6% from 3%, and we think it'll sink further. So what do we expect? We expect bonds and preferred shares will still be useful in your portfolios as stable, non-volatile investments, throwing off cash flow in a reliable way, 3 or 4% for straightforward preferred shares and bonds, a little bit more if we take some credit risk on bonds, and maybe a little bit more if we can buy convertible bonds or bonds with some added features. We're not going to get rich buying bonds, but they're very useful as stabilizers to keep your portfolio from being as volatile in the market. So we're going to continue to buy bonds with low maturities, that is to say bonds that come due in less than 5 years, and we're going to continue to buy credit risk. That is to say we're not buying Government of Canada AA or AAA bonds, we're buying corporate bonds, which come with a little bit more risk, but we get paid for that. And because we do our analysis and research the companies, we don't feel we're taking undue risk. So nobody's going to get rich from bonds, but still useful. Currencies. Hardest part of my job is talking about currencies. I got currencies wrong last year. I thought the Canadian dollar was going to stay above par all of 2013. I was wrong. We've slipped down, I think, as low as 94 or 95 cents on occasion. And the Canadian dollar's averaged about 98 cents this year. I said it was going to be $1.02. Got that one wrong. 2014, Canadian dollar, I think, will average around where it is now, about 96 cents. May go down as low as 92, 93 if oil dips, may get up to 98 or 99 cents on occasion, but I think where it is now is about where it's going to stay, which means if we buy U.S. stocks, we're not going to take the risk of getting whipsawed by the Canadian dollar going back to $1.10 and our U.S. stocks being less valuable. We don't think there's much risk of that. We think the euro is going to strengthen as the European economies strengthen, which means that buying European stocks has an upside to it. Not only will the companies do better and make more profits, but as the euro rises against the Canadian dollar, you get a bit of a currency lift at the same time. So don't be surprised if in 2014 you find some European stocks creeping in to your portfolios. We're still not interested in emerging markets, and in particular, we're not interested in the so-called BRIC countries, Brazil, which is having very serious problems right now, Russia, which is run by thugs, and we're not interested, India, which is completely disorganized, and China, which does not have the rule of law and is run still, lest we forget, by a totalitarian communist government that puts people it doesn't like in jail. So we don't want to invest in those companies, those countries, at least not directly. So what are we going to invest in? Well, on page 21, I talk about the sectors that we think are going to do well. And somebody in the second row asked me about real estate investment trusts. We think real estate investment trusts were greatly oversold because of the interest rate panic in the summer and are still tremendous bargains, offering cash-on-cash yields in excess of 6% and real capital appreciation possibilities of up to 10 to 15% in 2014 as people recognize that interest rates are going to stay low. And let me say, by the way, when people had the interest rate panic and sold the REITs, they didn't realize that rising interest rates are a double-edged sword for real estate owners. When their mortgages come due, they have to pay more, but rising interest rates implies rising inflation, which gives you the opportunity to raise rents. And to the extent that rents are greater than your mortgage payments, rising inflation can be very positive for landlords. This was ignored by the people who sold the REITs willy-nilly. We see tremendous opportunity in the REITs. The Canadian banks, I think 4 of the 6 Canadian banks are at record highs as of today. And people might say, geez, why would you want to buy a bank when it's at its highest price ever? Well, the answer is because their profits are at record highs and they keep growing. Their dividend payouts are around 50%, which means they have capacity to raise their dividends. They're operating in a wonderful protected oligopoly. 6 of them have the entire market. Nobody else is coming into Canada. They saw the experience of the telco companies. They saw the experience of people trying to buy oil companies. There are no foreign banks that are going to compete with the big 6 in Canada, which means they're going to keep making money. And I was a little worried about what Mr. Harper might do in his budget yesterday about the banks, but nothing too damaging. And when people, by the way, complain about their bank fees and the banks making too much money, I say there's an easy remedy: buy bank stock. And I continue to give that advice in 2014. Buy banks. Our favorites remain Bank of Nova Scotia for its international exposure and growth possibilities, TD Bank, which as the American dollar is stronger against the Canadian dollar, repatriates profits which grow when translated into Canadian dollars, and National Bank, which is oversold because people are worried about Quebec. We don't think Quebec is separating. Major Canadian retailers are in for tough times. You probably know that a lot of American big chain stores, Nordstrom's, Target, are coming to Canada. This means basically lower prices, competition for rents, and for prime real estate. Tough times for Canadian retailers. And of course, it's very difficult for most Canadian retailers to export their brand outside of Canada, has been for years. So our Canadian retail exposure is going down. Those of you who own Shoppers, which is being taken over by Loblaws, will have noticed that we sold our position in Shoppers. We're out of that one. We don't have much retail left. Precious metals, I've already talked about. It's a sector which we have no interest in. Base metals and material, terrible 2 years. It's tempting to say, well, those stocks have been beaten up. They've gone down. And Ned Goodman, a guru on precious and base metals, was on BNN today. And he said, I do what Warren Buffett does. I buy them when they're down. Well, who am I to say Ned Goodman is wrong? But I think it's going to be a long time. What happened when the commodity prices were so high is extra supply came into the market. The giants, BHP Billiton, Rio Tinto, and so forth, basically brought new mines into production just as demand peaked. And as demand fell during the recession, all that new production came into the market. And all of us know if there's excess supply and falling demand, prices go down. We're not going to buy a lot of base metals and materials in 2014. Energy stocks, similarly, there's been a fundamental change in the world in energy. Fundamental. The tight gas, the Baskin formation in both Saskatchewan and North Dakota has changed the energy equation forever in North America. Forever. Coal is going to be phased out. Uranium, in our view, there aren't going to be any new reactors built in North America, both because of Fukushima, but also because gas is cheaper and easier. Wind power and solar power have disrupted the European energy markets enormously. And if you have the opportunity, read the lead article in The Economist magazine this week about what's happening in Germany and to the 10 biggest European utilities, which are competing against subsidized solar and wind and are basically all going bankrupt. We're staying largely away from energy in 2014. Utilities, pipelines, and telcos, the stable dividend producers, again, like the REITs, oversold this summer when people were concerned about interest rate. Good opportunities. We were concerned, as everybody else was, that the federal government was going to kill the telecom industry. They were desperate to have a fourth telecom company, not so desperate that they'd let Manitoba Tel sell Allstream, but somewhat desperate. No foreign company bid for spectrum in Canada. No foreign company. It remains the big three. They're making a lot of money. They're going to continue to make a lot of money. We should continue to own them. Similarly with the utilities and the pipelines, they're regulated industries where in a low interest rate environment, the yields and the rising dividends are very attractive to us. Consumer products, both durable and non-durables, average to above average except for cars in the durables. We know that the American car fleet, both in Canada and the United States, is still at a record high age of over 8 years because for 5 years nobody bought cars. The car companies are now back to their peak production levels of about 16 million units, and it looks to us like they're going to stay there for 2 or 3 years. Some of you will notice General Motors cropping up in your portfolio this month, and some of you have Magna. We think those sectors are pretty good, and durables are a good place to be. So that's what you're going to see in your Canadian portfolios by and large. U.S., if you look at the graph on page 22, we had the same graph last year. And the difference last year, which is the blue line, which was the S&P 500, was significantly below the yellow line, which is earnings. And you can see that those two lines have now caught up. The S&P has gone up over 20%, about 20%. So the S&P has caught up with the earnings trend. It's no longer cheap. I stood up here last year and I said to you, U.S. stocks are cheap. Look at the graph. You can see they're cheap, and they were cheap and they went up, and now they've gone up. Now we have to be pickier with our U.S. stocks. We have to find things that haven't participated to a great extent. So where do we find that? Technology stocks are trading by and large at 2/3 of the multiple of the S&P 500. So companies like Oracle and Cisco and Microsoft and Apple are trading at 10 or 11 times earnings compared to 16 or 17 times for the market. Still bargains. Major multinational brand companies will benefit from Europe. People don't recognize that for companies like Coca-Cola and Pepsi and McDonald's, more than half of their earnings come from outside North America. And strengthening economies in Europe are very good for those kind of companies. Healthcare companies, which we don't have in Canada, are going to benefit from Obamacare, or the Affordable Health Care Act, as it's actually known. 35 million Americans without health care are going to get health care, whether Republicans like it or not. That means they're going to get doctors, they're going to get medical devices, they're going to get pharmaceuticals. It increases the market for all those healthcare products in the United States by about 15% from scratch. We got to own some of those companies. Banks in the United States have made a wonderful comeback, and one of the reasons is that real estate has made a great comeback. Banks with a lot of real estate on their books had tremendous loan loss reserves, but as house prices have increased in the United States, increasingly they're able to reverse those loan losses, and that turns into profits. Underwriting for banks like Goldman Sachs and JP Morgan will be increasingly profitable as we see companies like Twitter go public and they make a lot of money. So we're going to buy some of those companies. Finally, on the last page, as we always do, we've outlined a couple of the stocks that most of you own in your portfolios and given some of the salient statistics, some of the ratios that we follow about those companies, just so you can see if we're doing what we say we do in terms of being value investors. So, I'm sorry I went past my 20 minutes, but I hope it wasn't too boring. Synopsis: low growth all over the world, low interest rates. Don't be panicked about utilities and REITs. Buy them because low interest rates are your friend in those situations. Buy American healthcare, buy American technology, buy Canadian banks and telcos, eschew materials and commodities. That's our plan for 2014.